When will rates go down? All right, spoiler alert. In every scenario, rates are going to come back down. It's just a matter of when. If you're sitting on the sidelines trying to time the market, the question you might want to ask is, why are rates staying higher for longer? Where do experts believe rates will go in 2024? And what could the next 5 years look like? When rates do begin to drop, we're in store for another hot housing market where there are more buyers than there are sellers, pushing upward pressure on home prices, because we haven't solved the problem of low inventory. Therefore, the affordability problem will remain. Getting in front of this is key to your success. So let's jump into the first question on why rates are staying higher for longer. I mean, remember, it was only a few months ago when economists claimed that 4 and 5% could be in our 2024 mortgage rate forecast. Still high on a sugar rush of market expectations for 6 Fed rate cuts starting as early as March. While a lot of headway has been made towards the target 2% inflation goal in 2023, January's data on job growth, inflation, and fourth quarter gross domestic product pushed the scale towards a tap on the brakes. February's data then pumped the brakes even harder when job gains moved back up to 275,000 new jobs created, making the 3-month average a strong 265,000 jobs. And the various inflation measures continued to come in hot. Consumer Price Index, or the CPI, increased 0.4% for both headline and core, with shelter and gasoline making up 60% of its rise. This pushed the most recent 3-month CPI average back up to 4.2%. Producer Price Index, or the wholesale inflation report, came in next, jumping to its highest level in 6 months. Personal Consumption Index stalled at 2.7%, which sounds good until you realize the month-over-month hit 0.333%. Now, if you multiply that times 12, you're back to a 4% annual inflation. Then the prices index inside the ISM manufacturing report started increasing faster, pushing U.S. manufacturing to a 22-month high. I mean, inflation will not go down easily. In fact, even if we conservatively get a 0.2% monthly inflation growth on core PCE for the next 6 months, we'd only see a 2.6% annual inflation rate, literally just in time for the Fed's November meeting, which is still far from their 2% target. On top of the resilient inflation data, personal spending defied all odds. Personal spending surged 0.8%, despite the Bureau of Economic Analysis report showing inflation-adjusted real income is actually down. This continued consumer spending encourages a strong GDP, which supports higher prices and higher wages, ergo higher inflation. Strong rates of returns on bonds and money markets, crypto and equity markets helped consumer sentiment hit a 2.5-year high this past month. As long as consumers feel wealthy, rates will stay higher for longer. With all of this, the hopes of a May rate cut have vanished. Hopes for June shrank. Fed Chair Powell has indicated several times and is yet to back off from his promised 2 to 3 rate cuts in 2024. Now, warranted or not, they likely will. So what exactly has to happen if inflation stays sticky? We will need to see an unexpected weakness in the labor market, which would be demonstrated by a 4 to 4.1% unemployment rate. Now, this is jobs week. Last month's unemployment rose from 3.7 to 3.9%, which is getting us closer to that 4% mark. All hope is not lost for rates, even with the sticky inflation and while we're waiting for unemployment, meaning while 4 and 5% is off the table, a nice low 6 is still on the menu. I mean, Fannie Mae raised their forecast from 5.9 to 6.4% at year-end 2024. Lawrence Yun with the National Association of Realtors was last quoted as saying, given the high budget deficit and uncomfortable inflation metrics, he's forecasting rates to remain between 6 and 7%. The Mortgage Bankers Association raised their forecast to 6.1%. And Bright MLS's chief economist predicts rates to hit 6.2%. Now, personally, I'm sticking with the same 6.2% I've been saying since December. There is light at the end of the rate tunnel, however. While we might not know exactly when, the if is pretty secure. On March 20th, the Federal Reserve released their updated Fed dot plot, which showed a projected 2.25% interest rate cut by the end of 2026. This would reduce the Fed funds target rate range from where it is today at 5.25% to 5.5% to 3 to 3.25%. This assumption is based on inflation stabilizing at 2% by 2026, not 2024. This is a longer road than we have hoped or wanted, but it's closer to the truth than the market exuberance creating intense volatility in our mortgage rates. There is still ample liquidity and strength in our economy to keep rates higher for longer for now. If the inflation rate settles in at 2% in 2026 and holds, we should see mortgage rates remain at their low levels for the balance of the next 5 years. So what do you do with all this information? You look further out than today. Rate volatility, missed expectations, and concerns of affordability can justifiably keep you on the sidelines or guessing how to time the market. Timing the market is so yesterday. Know what today holds? Understanding the market. Taking advantage of created opportunities today to provide wealth and options tomorrow. I want to share 4 of the many strategies I'm talking to my clients about right now. One is seek a renovation project. Homes that have been sitting on the sidelines simply because they're outdated, they're missing a master bath, or lacking street appeal are a golden gem. You can do a renovation loan today, roll in all the costs, put the minimum required down, and then refinance into a lower rate once rates drop. A second option is look into a reverse mortgage if you're over the age of 62. All of that equity sitting locked up in your home is not adding to your cash flow. But you know what will? Optimizing that equity into 1 or 2 rental properties in an up-and-coming neighborhood or metro where the growing Gen Z population is moving. A third is tap into the bank of mom and dad. I mean, it's a real thing. They are doing well and know the power of real estate, especially since it's one of the reasons they're doing so well. And number 4 is for cash buyers. You guys, stop it. I mean, seriously. Yes, rates are hovering around 7%. I get it. But if you could not only buy that primary home, but 1 or 2 rental properties where tenants are paying down your mortgage, could you see the gain? You would have 3 assets appreciating with the opportunity to refinance on the horizon. If you knew the odds were in your favor that rates would be lower over the next several years, that appreciation is already returning to pre-pandemic averages, and that it's impossible to build more land, would you stop trying to time the market? Since the right time to buy might be right now. Well, that's a wrap. Until next time, this is Nicole Rueth with the Rueth team. It's my pleasure to keep you updated.